Meta Platforms reported quarterly financial results after the markets closed on Wednesday, October 30th, 2024. Investors didn't like what they saw from the company, and the stock price fell in the aftermarket hours following the earnings release, and the stock price drop has continued this morning. What did investors not like about Meta Platforms? I'll talk about that in this video. I'll also discuss several of the other big picture items investors should take away from the company's latest earnings release. I'll also update my buy recommendation on Meta stock. Remember, I've had this stock rated as one of my top stocks to buy all year now in 2024. It was also one of my top stocks to buy in 2023. So am I keeping it there following these earnings results? I'll let you know by the end of this video. So let's digest these results.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Meta Platforms reported revenue of $40.6 billion in the quarter that ended on September 30th, 2024. That was up by 19% year over year. That's excellent top-line growth. If you compare this with the other ad-supported companies that have reported earnings so far, including Alphabet and Snap, those two former companies reported 15% revenue growth. So Meta Platforms reported 19% revenue growth, 4% better than both Alphabet and Snap, which also rely on ad revenue. Comparing it that way, it was a successful quarter for Meta Platforms right off the bat. To make the quarter even more impressive, the company's operating profit margin expanded from 40% to 43%, demonstrating the lucrative business model that I've been talking about for some time now with these businesses that are relying on user-generated content. Meta does not create the content on its platform. People like you and me post pictures, comment, like, and do other things on the platform, and Meta gets to generate revenue off of those interactions. That's a great business model. Meta has proven how great of a business model it is, generating an operating profit margin of 43% on $40 billion in revenue from a product it offers primarily for free. So that's why I've highlighted this specific business model as one that is an attractive one for investors. The company reported family daily active people increased by 5% to 3.3 billion. These are people that use one of Meta Platforms' family of apps, which includes Facebook, Instagram, WhatsApp, and Threads. These are 3.3 billion people use at least one of those apps on a daily basis, and that was up by 5% year over year. That means they've added over 150 million users in the last year. That's phenomenal to add that many users when you're already at over 3 billion and still finding new people to add to your platform. It's benefiting certainly from the network effects, and it's going to be difficult for any of the competitors to encroach on Meta's business. Ad impressions increased by 7% year over year, and the average price per ad increased by 11% year over year. Now, a lot of investors are concerned about Meta's spending on artificial intelligence, but one way you can already see the benefits of it is from the ad impressions and the average price per ad. The ad impressions increasing by 7% year over year signals more engagement on the platform. People are spending more time on the platform, which gives Meta more opportunity to show ads. People spend more time on the platform if Meta can surface relatable content that keeps people engaged. So by having a better AI capability, the algorithms can recommend better content that fits the needs of the users and keeps them engaged for longer on the platform. You're already seeing evidence of that for several consecutive quarters. And then the average price per ad increasing by 11% year over year signals that marketers are getting a good return on investment and they're willing to pay a higher price. Again, that highlights the AI capability matching advertisers with users that are good prospects for their businesses. And so they're getting a good return on investment, and so they're willing to spend more money on the platform. Now for the concerning stuff. Meta said that its headcount increased by 9% year over year to 72,000 people. For a while now, the large tech companies like Meta, Amazon, Microsoft, Alphabet, they had been doing more with fewer people. Remember those big job cuts that tech companies announced in late 2022 and early 2023? They had reduced their headcount by tens of thousands of people and maintained revenue growth despite fewer people. Meta now is the first one out of the ones that I've been following. Alphabet still had a year over year decrease in headcount, but Meta actually increased its headcount by 9% year over year, which might signal that the days of it being able to grow revenue with the same amount of people has ended, and it needs to add more people to generate increasing revenue. Revenue growth is expected to remain strong. Meta is forecasting fourth-quarter revenue of $46.5 billion at the midpoint, which would be roughly 15% more than this current quarter, where it reported roughly $40 billion in revenue. Total operating expenses are actually expected to be lower by $500 million at the midpoint, but total capital expenditures are expected to be higher by $500 million at the midpoint. And then Meta Platforms forecasting growth in capital expenditures in 2025, significant growth in capital expenditures in 2025. And I think these capital expenditure numbers, coupled with the increasing headcount, is what had Meta Platforms stock down following the earnings release. It's down 4% now as of this recording. And that's the reason, because Meta Platforms is hiring more people. They had to hire roughly 7,000 more people. And then they're spending $500 million in capital expenditures and then forecasting a big increase in 2025. So 2025, you can expect something in the range of $50 billion, maybe if you're lucky, only $45 billion. But I don't think that's such a bad thing. I've been talking about this with these tech companies spending on AI. I don't think it's such a bad thing. You can see already the increase in property, plant, and equipment net of depreciation in the 9 months of 2024. It's gone up by roughly $16 billion from $96 billion to $112 billion. But you can see the company has significant cash, right? Still, even after all of that spending, Meta has $43 billion in cash and $27 billion in marketable securities. So it has $70 billion of cash just sitting around, earning what the savings account and short-term government bonds will earn the company 4 or 5%. I find it hard to believe that these investments in capital expenditure on AI are not going to deliver much better than 4 or 5% and on a risk-adjusted basis deliver a good return on investment. These companies have been notorious for hoarding capital. They've hoarded capital for years and years and years. And now that they're deploying capital, it's reasonable to assume that they found something very worthwhile, and that's why they're spending so much. These people that are managing these companies have been prudent, especially Meta Platforms. They've been prudent with the capital, and now that they're deploying the capital, it's reasonable to assume that they found something that's worth spending on. And I say the same thing with Alphabet and Microsoft. They've also been prudent, and now they're deploying all this capital to AI. They probably see something that's very worthwhile. And the early indications, right, the early data that we're getting back from their AI investments are pretty good. Even though it's very early days, we're seeing good return on investment on those allocations to AI. All right, and cash flow from operations increased to $25 billion, up from $20 billion in the same quarter last year. It's up even more in the 9 months of 2024 to $63 billion, up from $51.7 billion. All right, so now, is the stock still one of my top stocks to buy? Well, it's now trading at a forward price to earnings of 23, which I still think is undervalued for this company and its prospects. So yes, I still think it's a top 25 stock to buy right now, and I updated that recommendation today, October 31st. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.